Thanks for having me, Scott.
All right, so let's just start with the NASDAQ, since that's where our lead was, and that's really what the lead of the market has been. You like it here? Do you think it has more legs? Is it running out of gas? What do you think?
I mean, we like tech right now. I mean, I think it's reasonably priced tech. And I think a lot of times what's going on is we have investors sort of moving into a bit of a safety right now. There's still the concern of the uncertainty of what's going on with the debt ceiling and still trying to figure out whether the Fed's going to pause. But that compression that we've seen in yields ultimately a bit is making it a little bit more attractive for tech.
Now, how do you make the argument that it's, in your words, reasonably priced? Because others suggest it's not reasonably priced anymore, that these stocks have had a year's worth of gains, if not more, in a handful of months, and now the valuations are too rich.
Well, we like semiconductors, especially if you go back to October lows, the semis are up about 46%. And so I think for us, it's about more bang for your buck. So it's not just tech as well. We're really looking at PE ratios, even looking at international stocks as well. So I mean, when we think about European equities, it's about I think the majority of those sectors are actually relative discount to the U.S. sector. So for us, it's really about that valuation component and looking at price earnings ratios.
Do you like outside the U.S. better than in right now?
We like the fact that we think the dollar is going to weaken a bit, and that creates a tailwind for international equities. And so we see the S&P as being a bit range bound from here to the end of the year. And so we do like European equities, I think, going forward for the rest of the year. We know they've performed quite strongly, but we still think there's some room to go on that trade.
You must think the Fed's done then.
We think we've hit or getting to the end of the tightening cycle. We're at 5.25%. It's possible that they could raise rates again, but we feel like they're going to hold here, restrictive territory, and likely won't see cuts until potentially the end of this year or the beginning of next year.
I mean, you are JPMorgan global investment strategist, as certain Jamie Dimon said not yesterday at the meeting that they had with investors, to be prepared for higher rates.
Well, he said be prepared, and I think that makes sense, right? Because, housing has bounced back a little bit. Inflation is still persistently high. Services inflation at 5.5% year-over-year basis. Labor market's still tight, right? And so there is the possibility that, inflation can still move higher and that the Fed may have to raise rates. But that's about being prepared. We expect that the Fed will likely hold from here, and then we'll see cuts at some point, either at the end of this year or beginning of next year.
You like U.S. midcaps, which is interesting. Why?
I think they're better priced or more appropriately priced for the recession that we believe is going to happen in the second half of this year. And so when we're looking at the S&P 500, roughly 18, 19 multiple, which is much higher than the 20-25 year average of 15. And so we think that midcaps can perform better in the next part of the cycle. And then they have an allocation to industrials. And we think that a lot of the infrastructure that's necessary in order for some of these tech companies to move to that next phase, infrastructure is going to be needed, especially if you think about EV.
Are you suggesting you'd rather be a little early in midcaps than late? Because if you think we're going to have a recession, and we also think that credit is going to contract, that maybe midcaps would not be a place that you would ordinarily suggest to be.
I get what you're saying there. I think what it is about what's priced appropriately and what's pricing in the recession. And so we'd like this entry point. Ultimately, there's always a reason not to invest in markets. And we think that clients should have a long-term view, and it's about building a robust portfolio. And part of that is having midcaps in the allocation. But our highest conviction view is bonds, right? They've created this great entry point, have rates at restrictive levels. Mm-hmm. That's creating an amazing point for investors to hop in that 7 to 10 year tenor for some investment grade bonds.
So your highest conviction trade right now is in fixed income?
Yes, absolutely. Investment grade bonds, I think clients should get in now instead of waiting for some of that certainty for the debt ceiling, waiting to see if the Fed pauses. Let's go ahead. Let's hop in. Enough with the T-bill and chill. It's time to hop in investment grade bonds.